All right, let's dive right into this explainer. Today, we're putting on our expert investment analyst hats to evaluate Vertiv Holdings. These guys are providing the absolute picks and shovels for the AI gold rush. But we aren't just looking at the tech today. We are going to run Vertiv through the gauntlet of legendary investing frameworks. We're talking Warren Buffett, Peter Lynch, Benjamin Graham, and a full DCF analysis just to see if this stock is actually worth your hard-earned money.
So here's our roadmap for today. We're going to outline the massive AI infrastructure boom, analyze Vertiv's financial surge through our guru lenses, evaluate their massive $15 billion backlog, look at their actual cooling tech, and then finally weigh the headwinds to give a definitive valuation verdict.
Section 1. The AI infrastructure boom. Now, we're all watching AI literally eat the world, right? But the digital gold rush actually has a very physical bottleneck. Think about it. What happens when AI gets too hot? Every new megawatt of compute, upgrading from 10 kilowatts to 40 or even an insane 100 kilowatts per rack, generates extreme heat that threatens to literally melt down data centers. Because of this, the dollar value of cooling equipment required per megawatt of IT load is just skyrocketing.
And that brings us directly to Vertiv, which is now a $122 billion giant. If we look at this through the Warren Buffett lens, we immediately see the makings of a really wide economic moat. Vertiv provides the highly specialized power and liquid cooling solutions that are absolutely essential to keep these AI factories running optimally. With 80% of their revenue coming directly from data center customers, they are deeply entrenched in an indispensable industry.
Moving on to Section 2, Vertiv's financial surge.
Okay, applying the Peter Lynch framework now, Vertiv very clearly falls into his fast grower category. I mean, over the past 52 weeks, this stock has surged over 143.5%, absolutely crushing the broader S&P 500. Wall Street is heavily rewarding their dominant positioning in the AI infrastructure space, and we're seeing it driven by massive institutional buying.
And when you look at their Q1 2026 earnings, you can see their financial leverage is working overtime. Adjusted earnings per share jumped an incredible 83% year over year to $1.17. Now, Lynch usually warns us about high PE ratios, but a PEG ratio, PE divided by the growth rate, well, it looks slightly more palatable when a company is expanding their operating margins past 20% and posting 30% jumps in net sales to reach $2.65 billion.
Section 3, the $15 billion backlog.
$15 billion. Vertiv's order backlog has crossed a staggering $15 billion, literally doubling in just 12 months. If you're running a DCF, a discounted cash flow valuation, this is your holy grail. It provides incredibly robust, predictable forward free cash flow projections coming directly from the world's largest data center operators. Having committed orders 3 to 4 years out gives them this unprecedented forward visibility straight into 2028 and beyond. Just to put that into perspective, most industrial companies operate with maybe 6 to 12 months of backlog. Vertiv's pipeline practically reduces their near-term demand risk to zero, which significantly solidifies those base case cash flows and brilliantly de-risks the terminal value for our valuation models.
Section 4, Cooling the AI heat.
So to really understand the durability of this moat, we have to look at the tech. Vertiv isn't just selling some commodity hardware. They actually co-developed SmartRun digital twin software with NVIDIA, which lets customers simulate whole data centers before a single brick is laid. Add in their strategic acquisitions in liquid cooling and integrated power modules, and they've built this technological ecosystem that is incredibly difficult for any competitor to replicate.
And that deep technological moat, it allowed management to confidently raise their full-year 2026 guidance. They're now targeting over $13.7 billion in net sales, with adjusted operating margins climbing to 23.3%. This specific type of compounding operating leverage is absolutely exactly what Buffett looks for in an industry leader.
And speaking of Buffett, he always evaluates management capability. Executive Chairman Dave Coates sums up their true advantage perfectly here. It's one thing to have the right liquid cooling tech in a lab. It's another entirely to manufacture massive, highly complex systems globally, at scale, when your competitors simply can't keep up.
Which brings us to Section 5, Headwinds and Market Risks.
Okay, let's play devil's advocate and apply the rigorous Benjamin Graham framework to this bear case. Graham demands a strict margin of safety, and frankly, Vertiv completely fails this test right now. They're carrying a massive trailing PE ratio of 80. Furthermore, they're facing evolving tariff margin squeezes like Section 122 and 232, and they just had a 29.4% organic sales drop in the EMEA region. Because it's priced for perfection, Graham absolutely wouldn't touch this without a massive pullback. But honestly, the ultimate risk to their valuation is execution. I mean, they are rapidly expanding factories to increase capacity by up to 7x for certain products. But they have to flawlessly navigate global supply chain bottlenecks and labor shortages to actually clear that $15 billion backlog. Any delay in these 18 to 24-month factory builds is going to directly impact those free cash flow forecasts we talked about earlier.
Section 6. The road ahead.
Wall Street analyst sentiment is overwhelmingly bullish, but you have to look at this extreme price target spread, from $236 all the way to $500. If you build a base case DCF, this spread actually makes perfect sense. Tweaking your discount rate, your WACC, and your terminal growth assumptions by just a few tiny percentage points creates a massive swing in fair value. The market is aggressively pricing in flawless future execution here.
The good news? Vertiv has a remarkably strong balance sheet with $5 billion in liquidity. Following their recent inclusion in the S&P 500, they're aggressively self-funding regionalized manufacturing. They want to capture market share and ensure they remain the absolute dominant incumbent as these AI deployment timelines continue to compress.
So what's our final synthesis on this one? Well, the demand for AI compute is undeniable. Through the Lynch lens, it's a phenomenal fast grower. Through Buffett's, it has a deep, undeniable moat with high operating leverage. But through Graham's lens, that 80x PE offers literally zero margin of safety today. It's a fantastic company, but at current valuations, it's really a hold for value investors, though momentum buyers might just keep riding the wave. Keep a very close eye on those cash flows. Thanks for joining me on this explainer, and as always, keep learning.